Listen up, folks. We just stepped back in a frickin' time machine and we got to live in the future, and now we're unraveling to the point where you can pick lottery tickets at this point and your percentage of winning is going to be amazing. When we went into that pandemic, what Kathy Wood was describing is just a technological jump, something we haven't seen since the 1800s. We're talking about going from internal combustion to electric, the entire blockchain revolutionizing basically the whole fabric of the financial system. I mean, this is happening. And yeah, it might be going through something like the dot-com era, but do you know what that means? That means we know that there's something big happening here. We just got too excited about it, right? So this is such a good buying opportunity. And just taking a look at the S&P 500 trading down 23% year to date, it's always recommended you zoom all the way out, look at what's happened historically so we can start predicting what's going to happen moving forward. And even taking a look at the dot-com era, I mean, the S&P realistically dropping somewhere between 40 to 50%. I've also noticed that each kind of recessionary crash period that's existed since then has been getting more and more narrowed, and they've been happening with much more, volatility, but in the macro aspect of things when it comes to obviously political, interest rate, inflationary environments, which you should never invest based off
who mix their politics up with their investment activities. I don't think that makes sense.
So the way I think it's going to rhyme most likely moving forward is we're going to see, again, inflation stay a lot higher than anticipated, which means, again, 0.75% basis hikes from Jerome Powell, which was shaking aggressively with his papers the other day. God, what a job.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
And as interest goes up, obviously the market's going to continue to be volatile and shocked by this. However, I don't think we're living in a period that was worse than what we witnessed through the pandemic, right? I think this is going to be survivable because it's largely related to fuel prices. There's a lot more certainties baked into the market unless a black swan event happens, but we had that with the geopolitical event with Russia, the Ukraine, obviously, right? And we saw that shock, got the large impacts from it. And if we can get control of the oil environment, again, largely driven by policy, I don't know if that takes a quarter, 2 quarters, 3 quarters to work out, but once that works out and fuel prices start again suppressing, it will offer a lot of softening to the rest of the market. A lot of stuff comes into play with these oil prices, so government's only going to stand for it for so long.
Just this morning, the president taking aim at oil companies.
I'd love to put a time frame on this, but it would be absolutely insane. This could be 6, 12, 24 months out. Who knows? But what I do know is my strategy, how I'm taking advantage of this market and solidifying my new risk tolerance and finding better ways of cost averaging into this market. We're going to talk about those lottery tickets as well, because you can't just pick random small caps in this and that. You have to understand the market's going to wean through the losers. This is like natural selection at this point. Those that got too greedy, the shore goes out. We get to see you swimming without shorts on. So first and foremost, I had a great conversation the other day with Joseph Hogue from Let's Talk Money, and he just posted a video because we had this in-depth discussion about strategy, but this great video today about what is a bear market, what causes a bear market, how long do bear markets last, what is a bear market rally. And this guy's got a lot more solitude than I have personally, because he's really prudent when it comes to these down periods about cost averaging and making sure there's extra capital in case things continue to drop. Whereas for me, I get a fire lit under my butt, I go all in at once, and then I try and figure out what I can sell, including my bed, shoes, whatever I got laying around the house, just to keep cost averaging into the market. I need to learn to take a breath, wind back, and something I'm adding to my current strategy. So go check that video out. I'm gonna leave a link in the description below, but guys, this is the current plan. Now, this isn't the finalized strategy. I mean, all the numbers are pretty equivalent to what I have in total, but I have not done all of this just yet. I haven't sold out of all my Canadian stocks yet. I'm still just kind of putting a plan out, and this is the framework that I'm thinking about doing for the current environment and just to make things easier. Many of you know I'm a huge proponent of VOO, and I've been primarily just holding my Canadian stocks individually at this point, but I'm thinking that there's more value for me in the S&P 500. So I'm going to take some of those Canadian stocks, convert them over to the VOO ETF. I've already got enough VYM. This is the current position, is worth about 86,000. My current VOO position is probably closer to about 80. So I do want to dump about 20,000 in value into the S&P 500, and then the newest addition, just to take headache out of the equation, VDY. I talked about this ticker before, guys. I recommend it to a lot of family, though I'm not offering financial advice. But VDY literally weights all the Canadian stocks that I love, the banks, telecom, energy, the Enbridge, all that stuff that I'm buying, right? So I'm like, why not just, it pays monthly. It's got a 5% plus compounded growth on the dividend year over year. It's a beautiful ETF that just simplifies a lot. So I'm like, it pays monthly. Let's get it in there and then just, hit the drip on and forget about it. And if something comes out of favor because I'm not paying attention and, someone's swimming without their shorts on and they get caught, I don't have to worry about it because it'll just be auto weighted, right? So I'm going to take the cumulative of these and use these as like a fundamental base that I'm not going to really mess around with. I can cost average into month over month, right? But I want to get more into the speculative. I need to make back the losses that I've experienced, which were well over $50,000 at this point. I'm sure you're all feeling that insane pain. So from the risk basket, I know I've got my REITs still in here because obviously these indexes don't really weight REITs, so I'm going to keep my Canadian REITs. I know they're going to get slaughtered. A lot of you told me I should have just bought, the 2x daily bear on the Canadian REIT ETF, which a lot of you were like, when I did a video on it, actually bought it and are doing okay with it. So congrats. More cojones than I currently have to want to go short a broad market. But nonetheless, folks, so the REITs out of the way, I still really want to buy about 3 things is what I'm generally looking at right now. So obviously, this is a new one, but I've talked about these ETFs before. The ultra short QQQ ETF. No, I'm just kidding. I don't want to short the Qs. I want to go long the Qs, but I want to triple leverage it with TQQQ. Man, I can't get over anyone shorting the QQQs triple leverage to the upside, up 130% year to date. But when the market decides to finally find its bottom, which I'll never know when that's going to be, obviously, and I'm going to be a little more patient if I'm going to do this play, I just want to see some kind of blue sky moving forward. Like the Fed saying, okay, inflation's cooling down. We're seeing the numbers decrease month over month. Interest is likely going to find a level, and then if not anything, come back down. I just want to find a leveling so we're not in this trend downside. And I'm thinking about just dumping 10 grand in here. Because I don't know, I love the Qs, but I also want to get that money back that I lost within reasonable risk, amount of risk that I'm still willing to lose, right? So that is a proponent of the growth. I mean, I've talked about Google and Alibaba. I'm debating on buying these just to give me a little bit of foreign exposure, something I don't have in the portfolio. And Google is just because I think at the current valuation against even Facebook, Apple, I just really like how Google's operating and their business model. I mean, I work, Google. But nonetheless, other than that, Bitcoin, talk about time machine, baby. I'm not going to start an argument here. I don't need to get into if you're bearish or bullish on Bitcoin. I just know that when I started buying this, I still like it for the same reasons when I started buying it. So I don't really care that it's down. I already sold a bunch of it a while ago when I was recalculating my risk tolerance. And sure enough, again, recalculating and adjusting worked out to my favor. I would have lost a lot more money than I have. But now I've got a good opportunity to finally start buying this sucker back. So I'm waiting to see, and I have been buying, but I'm waiting to see if it gets below that 20,000 range. And surely enough, if it does, I'm going to just start allocating pretty regularly to it. And I'm not sure how much. I'm not really definitive on exactly what I want to put in here because right now I'm just throwing 30, 50 bucks in it here and there, nothing crazy. But I don't know. Those are my speculative plays in the current strategy here, folks, as I'm going to start converting my Canadian stocks into ETFs that literally just represent the views and opinions that I currently have. And try and see how things pan out. But I want to know what you think about all of this in that comment section below. And in light of this, stay cool, stay awesome. And as always, I look forward to catching you in the next one.